So, Ernie Caballero, Managing Director at Goldman Sachs.
Yes, sir.
Does it still feel like a new year for people who are asset managers?
Still does to me.
Good. Well, 2024, the S&P finishes 25% ahead of the previous year. 2023 was up 23%. And as I kind of alluded to when I mentioned the new year, we have all kinds of things going on, right? All kinds of White House initiatives and that may impact industries and markets. How are you feeling about 2025? How would you characterize the investment year ahead?
Yeah, I wouldn't say just me, but there seems to be a lot of optimism in the markets. You know, when you couple that with a strong U.S. economy alongside growing corporate profits, and we're in the middle of earnings season right now, and everybody sees that. And you couple that with all the advances in AI. I mean, I think AI was mentioned. I lost count of how many times it's mentioned so far.
Yes.
It'll still be continue to be mentioned a lot throughout this conference as well. And then when you think about the shift towards a neutral monetary policy, you know, all of that sets up a very good backdrop for financial markets in general. But specifically the U.S. economy, it's in a pretty good spot right now.
So aside from data, the economic data, what excites you about the U.S. economy now?
Yeah, not to belabor the point that was mentioned earlier, but it just feels like we're on the cusp of the emergence of an American Renaissance. And you think about, you know, all the investment that's pouring into this country. You think about AI. We've talked about it a lot. But you think about everything that's being ushered in, there's a lot of business activity. You look at the forecast for CapEx, they continue to rise. And you look at the stuff that's breaking ground. There's more and more projects that are coming online. We'll take a couple that are pretty much out there. On the large side, which I think is the largest greenfield project that the U.S. has seen in quite some time, is TSMC, that announcement last year. A $65 billion investment to build 3 chip fab plants in Arizona. And that's going to bring thousands of jobs. And a whole host of things on top of it. Then you go to the smaller end, and let's say like an Eli Lilly. They made an announcement last year where they're going to be investing $4.5 billion for a local Indiana-based research and manufacturing facility, creating jobs there. So it just seems like the opportunities are not concentrated in a certain part of the geography when it comes to the U.S. It just seems to be spread out all over the place. It just seems to be a lot of investment in the U.S. in general. So, Brett, I don't know if that's answered your question, but just there's a lot of optimism.
So you mentioned the fact that AI has been mentioned a few times here already, but I would like to talk more about it. I mean, yesterday we had a $97 billion offer from Elon Musk to buy OpenAI, right? Which will no doubt stir some interesting conversations in the days ahead. I don't think we've heard the end of it, conversations about privatization of a nonprofit, among other things. Give us a bit more perspective on AI, and how do you see companies integrating AI into their investment strategies and into their businesses in general?
I don't even know where to begin. The universe is unlimited when it comes to AI. You know, taking a step back, I like to think of the world as we are all bound by limitations on creativity. You know, simply put, when you layer AI on top of that, I mean, it's just incredible. It's opened up, you know, the possibilities of what a future could look like, you know, when we have intelligent machines, you know, not the robots, but just anything that's even a code or anything like intelligent machines that'll help us reshape some of the society, you know, factors that we deal with today. Everything from just simple aggregating data, analyzing it, regurgitating it back out, to forecasting it, to helping you manage inventory, management systems, HR systems, you know, from that perspective all the way to drug development. You know, AI, there's a bunch of companies that are even spawning now for the way they kind of invoke AI into their research and development. You know, so think about that. Human genome, you start putting all these things together. If we can cure diseases, as an example, even before they happen, I mean, the possibilities are endless. And we had some of the previous panelists come up here and they talked about the different use cases, but the use cases are endless. If you can think about it, it's there. You just have to, have a little bit of a stretch in terms of their creativity. But the other thing too is it becomes more ubiquitous in all the use cases. It just becomes to be widely used. There's a lot more CapEx that continues to flow into it. Companies and people continue to adopt it because of the efficiencies in cost, knowledge, experience, whatever it is that you want to use to help justify the utilization of it. But it continues to spawn a reinvestment cycle. Costs continue to go down. It becomes more ubiquitous. Think about, what was it in the 80s when you had a cell phone? It was this big thing. You go back to the Apollo moon landing. All of the technology that was in those spacecraft is on your iPhone today. In fact, there was a lot less technology on that spacecraft than there is on the iPhone today. It's incredible. But in terms of investment opportunities, it's going to impact everything. So when you think about data centers, which I believe we mentioned earlier with the Southern Company, all the resources that are going to be needed to power those data centers, all the minerals, just everything you can possibly think of. It's spawning the entire ecosystem of AI. It's just getting us started. It's really the dawn of a new era that I would even argue. And the possibilities, they're endless. We're boundless. And remember, we're limited by our bounds on creativity, the way we think about it. So,
yeah, what about the integration using AI for portfolio management itself? I should mention that you have been managing for some time at UPS prior to Goldman Sachs,
right,
the pension funds for UPS employees, this ginormous pension fund, and now you're a part of Goldman Sachs for the past 6 months.
Yep.
You and your team,
yes,
all rolled into Goldman Sachs.
Right.
How's that working out, and how should we on the outside view this transaction, and what benefits are there for your fund holders?
All right. There's a lot of questions there, a lot to unpack. So first one, AI and portfolio management. Again, the possibilities are endless, but if you think about diligence, even on the private market space, the aggregation of data, the ability for you to kind of level set all of the information that comes in to really, basically dilute or, dissect everything into its pieces that are important across industries, across different investment companies, across different investment criteria, to do that, I don't want to say on the fly, but a lot faster and a lot quicker and a lot more meaningful than we were to do it manually. There's one thing there, portfolio investment manager monitoring as an example. We used to be sending out questionnaires all the time as part of our our annual compliance and monitoring thing. If you can automate all that, and use AI to help with all of that when you get the results back, just the possibilities are endless there. And there's a lot of investment companies out there using AI in the way that they look to invest and source investment activity as well. So getting into this transition of Goldman, what I will say, the Goldman opportunity has been great. It's been really awesome. So kudos to the Goldman folks.
That Goldman, by the way, they just gave couple of $80 million retention bonuses to the top executives. So you're in a good place.
Yeah, Goldman is great. It's a growing company, and there's a lot to like about Goldman. But focusing on the transition itself, they really took their time when the deal was announced. And I had a 20-plus person investment management team, of which I was the CIO of. But they took the time and they invested a lot of effort in making sure they understood who we were, how we invested, what our strengths and weaknesses were by an individual, and the way the whole portfolio came together, the investment objectives, just everything. They really took a lot of time doing all of that. And that helped transition a lot, much better, because we were all moving over to a good place. A lot of investment acumen, the resources were broader, the reach is global, it's much bigger than we ever would have had. And they made us really feel at home. It was really great. And when you think about it, they took all the stuff that we had, we moved it over to the Goldman platforms, and it was very seamless. But a lot of that is because of the teamwork, and the focus that they had on the people.
So managing pension funds, long-term investment approach, right? How has that Has that changed in any way?
No,
This?
no. The good thing is a lot of the investment acumen and the investment approach that we had was very, very similar. And that's really, I would argue, more than 90% of the battle. So the way we thought about investing for pension funds, right, because it's more long-term, and we have to lean on the liabilities, as I like to say, in addition to trying to achieve growth. But they did a lot of the things, that they thought about things very similar to the way we did when we were running our pension funds. So even from that perspective, it was really good. The dynamics worked out well. It was just, I really have nothing bad to say about it. It's been really, really good. And now that we're on the other side, it's about growing your investment career in ways that you haven't thought possible. At a fund, even though I had 20-something people, we still had limitations. AI being one of them, right? How we're going to use AI for a lot of these things. Now that you're in Goldman, it's a broader reach, the global reach, the investment research, the thought leadership, everything that they have at their fingertips is all available to us. And we still watch over the UPS funds, but there's a lot more. So if somebody wants a career in certain areas, fixed income, private markets, whatever it is, research, it's all there, and you can spend a lot of time there. So it's a really, really good move. It helped the participants. It helped UPS. It helped us as a team and Goldman as well. So overall, it's been a really good experience pre-transition, during transition, and post-transition 6 months later.
Yeah, more resources at your disposal now.
Yeah.
So what are the red flags for investors, right? What are the big red flags out there now? What gives you reason for concern as you look at the market?
There's always, nothing is risk-free, right? There's always some type of volatility. There's always some type of risk that you need to be aware of. Let's put it this way. There's always a reason not to invest. You had mentioned the 23 and the 24% returns that we had the previous couple of years leading up to this in the S&P 500. If you were to go back to, let's say, 2000 or December 31, 2019, the S&P 500 was, I think, around 3230. December 31, 2019, we're at 5881. If I remember correctly, that's 83% return, 12% compounded annual growth rate just for that index alone. But throughout that time, we've been through the dot-com bubble, the GFC, COVID. There's been a lot of volatility. There's always reasons not to invest. But if you stay committed to the long term and you have a diversified portfolio, you're going to see that the market rewards that, for those folks that look past the tactical reasons of not to invest in tactical volatility that you're faced with on a daily basis. You look past it and you invest for the long term and you have a diversified portfolio, you'll weather all the risks. And if you're diversified, you'll be in different geographies, different asset classes. There's just, that's what a diversification portfolio approach takes. And that's what we did at UPS. So we leaned on the liabilities. Those liabilities are the pension payments that we have to make. We had open plans. And if you look at the cash flows there, about 70 to 80 years into the future, that's crazy. It's a long time, right? So we have nothing but time on our side. And so you have a strategic asset allocation. You have the right allocation. It's diversified, the way you need it to be. And, you make some tactical adjustments. You rebalance along the way, but you follow that through. And every year we would go through a cycle of, making sure that was the right allocation. Because liabilities would change. People would retire. We would have new people come on, and that changes the cash flows. And you just have to alter your allocation just a little bit. But anyway, it's long story short, Goldman does the same thing. And, the ethos is the same. The creativity is the same. It's the way we kind of approach is very similar. So risks, to get to your question, there's always going to be risks. There's always a reason not to invest. You just got to look past it. Markets are resilient. If you're diversified and you think long term, you'll weather the storm.
So the risk is always there. Does it feel like this is a time of an extraordinary number of things? We have, right, geopolitical issues in the Middle East and in Europe, right, weakening economies in Asia, et cetera. Does this time?
Well, one thing's certain, death and taxes, but there's always going to be risk and volatility in the markets. And, I think you stay true to form, to being diversified and thinking long term. Your portfolio is, some of it may have weaknesses, others may have strengths. It'll balance out to give you a good, steady return over the long run.
So what do you think you and your team, how many people are on your team there from UPS?
Including myself, there are about 22 that moved over.
What do you think you guys have gleaned from the last 6 months of being in-house at Goldman Sachs that you can share? What pearls of wisdom can you share with people here?
I would say that let's look at this in 3 buckets, right? And I'm focusing on my experience and defined benefit pension, which is kind of the nuanced world, part of the world that I lived in. But there's 3 takeaways here: trend, capability, and team. Trend being anybody who works in any company, they all really don't want DB around anymore. Defined benefit, it's kind of a rare breed these days. All in favor of defined contribution. Whether that's right or wrong is a subject for another day, but anybody who is involved in the DB complex, shall we say, will be impacted in some way, shape, or form. Whether it be an investment team or an actuarial firm or whatever, anybody who has that. The next thing is capability. This whole OCIO thing that I'm now a part of, it's matured to be very, very well run, the entire industry, and I would say Goldman in particular. What we had at UPS is we had open plans that were open and accruing, so it wasn't like frozen and closed and just a bunch of fixed income waiting into what I call runoff mode to kind of simplify it a bit. But we had open and accruing, plans, plus we had a lot of sophisticated investments in those portfolios. And they took that all on stride. So it just goes to show that the whole OCIO model has really evolved to take big plans like us. Take it on board, take it in stride, take the team, and really do a good job delivering for your clients. So that's the capability piece of that second part of the bucket. The third bucket there is about team. And if you focus on the team and treating people the right way and bringing them on, and maintaining that investment acumen and continue to encourage, being thoughtful and doing what you're doing, and, just when it comes to investing and focusing on the clients, putting them first, this part that we've landed in is probably the best of both worlds. So being on a small team at UPS, small relative to Goldman, it was small. We had our limitations, but at Goldman, it's much, much bigger. It's better. It's broader. It's deeper. Any investment that you want to get into, we can get it done there. AI is also a theme throughout the entire company as well. So it's pretty cool when you think about it.
Good. So here's one question from the audience. We'll take a quick shot at. I hope you're okay with this. I think I know what they're talking. I thought about this earlier when the gentleman from Experian was up here, and I thought about the Consumer Financial Protection Bureau, which the president, I think yesterday or the day before, told them to stop working or stand down or whatever. What are your thoughts regarding hatchet cuts rather than precise, thought-out reductions? And maybe the CFPB is something to weigh in on in that respect.
Yeah, so for every pro, there's a con. And what I will say is if you keep doing the same thing, don't expect a different result, right? So I don't know what to make of it. Some hatchet cutting may be necessary. Some thoughtful reductions may need to be necessary, depending on where you're focused and how broad, I guess the organization, the firm, or the place that you're looking to try to potentially right size. I'm just trying to read through the question, make sure I understand it, but it really depends. What we don't understand are the objectives, what's trying to be accomplished, and is the approach that's being taken, will it get you there sooner rather than later? I don't know really how to answer that question.
And do we lose critical services in the process of getting there?
You could not. I could tell you this, if you equate it to a company when they announce layoffs and, let's say workforce reductions, a lot of people think it's like hatchet cutting at some point. And sometimes it's pretty thought out. You just don't know how this sausage was made on the other side.
Sure.
Right? So there's a lot of nuance with all of this stuff. And what you read as a headline, which all of us just like the catchy headlines, is not always, the depth of the story, shall we say. So
yes.
I don't know. I think it's necessary to do all of these things as long as they're well thought out, although it's not popular. It's what keeps us going in the future.
Secrets in the sauce, as Ross Perot said, the devil is in the details, right? Thank you very much.
Thanks, Brett. Thanks for having me.
Thank you.